By the end of this video, you are going to know everything you need to know on how to become a Forex trader as a complete beginner. I'm going to take you all the way from the beginning, from what is Forex, understanding technical terms like leverage, pips, spread, lot sizes, how to use trading tools like a pro, how to create a trading account, and how to actually analyze the market and take a trade. So get a notebook and a pen, sit back and relax as how we go into full details on everything about Forex trading. So without wasting any more of your time, let's get straight into the video. Now, what is trading? Trading is simply the buying and selling of financial instruments in order to make a profit. These instruments range from a variety of assets like shares, indices, interest rates, ETFs, bonds, commodities, and Forex. So these assets are assigned a financial value that can go up or down, and you can trade on the direction they will take. Now, let's say you want to trade an asset, and let's assume that asset is a commodity like gold. So basically, if you buy at this point and sell at this point, you make a profit. It's very simple. Now, what is Forex trading? Forex trading, also known as foreign exchange or FX trading, is a conversion of one currency into another. FX is one of the most actively traded markets in the world, with individuals, companies, and banks carrying out around $7.5 trillion worth of Forex transactions every single day. It's really, really big. Because I believe we all know what a currency is, right? Now, currencies are traded through a Forex broker and are traded in pairs. Currencies are quoted in relation to another currency. So, for example, we have the euro and the US dollar as Euro USD, or the British pound and the Japanese yen as the JPY. Basically, we call them Forex pairs. Every currency in the Forex market has to be paired against another currency. Now, let me elaborate on this so you can understand better. Say I want to buy Euro USD. Now, the current price of Euro as of recording this video is 1.04200. So this is the value of 1 euro in USD because it is paired against the US dollar. Now, if it were Euro JPY, for instance, I will be offering 156.25 yen to buy just 1 euro. So it's very simple. Now, we have three categories of currency pairs. We have the majors, we have the crosses, and the exotics. So basically, the major currency pairs always include the US dollar. For example, we have the Euro USD, we have the USD JPY, we have the Aussie dollar, and we have the USD Swiss franc. The majors are the most liquid pairs in the world, meaning they have more trading volume than the crosses and the exotics, and they are less exposed to high volatility, which simply means they are very stable to trade. Now, currencies that include any of the two major currencies except the US dollar are known as the cross-currency pairs, or simply as the crosses. There are a lot of crosses out there, but the most actively traded crosses are derived from three major non-USD currencies, which are the Euro, JPY, and British Pound. These are some examples of the Euro crosses, these are some examples of the Japanese Yen crosses, and these are some examples of the British Pound crosses. Now, what are the exotics? An exotic currency is a currency from countries with developing or emerging markets. Now, taking note of the word developing. Exotic currency pairs are made up of one major currency paired with currency of an emerging economy, such as Brazil, Mexico, Indonesia, or Poland. Basically, an exotic currency pair includes one major currency alongside an exotic currency. So some examples of exotic currencies are the USD Angola dollar, the USD Russian rubles, the USD South African rand, and the USD Brazilian real. Now, what are candlesticks? A candlestick is a way of displaying information about an asset's price movement. Candlesticks are basically how we know what the price is doing in the market. The most popular and widely used form of candlesticks is the Japanese candlesticks. Now, what are Japanese candlesticks? Japanese candlesticks is a type of price chart that shows the opening, closing, high, and low price point for each given period. It was invented centuries ago by this guy, a Japanese rice merchant, and was popularized by this guy among Western traders in the 1990s. So basically, we have two forms of candlesticks. We have the bullish candlestick and we have the bearish candlestick. The bullish candlestick are used to understand price in the bullish direction, while the bearish candlesticks are used to understand price in the bearish direction. Okay, so these are called the body, these are called the eye, these are called the upper wicks, or you can just call them shadows. These are the lower wicks, and these are the lows of both candles. Now for the bullish candle, this is the opening price, this is the closing price. For the bearish candle, this is the opening price, and this is the closing price. Now, what is a pip? A pip is a measurement of movement in forex trading. It is used to define the change in value between two currencies. Pip is actually a short term for point in percentage, and it is the smallest standardized move that a currency pair can change by. Now, the reason pips are kind of important is because pips are used by traders to calculate the spread between the bid and ask prices of the currency pair and express the profit or loss that a position has made. Now, if you notice, I use some more that may seem technical, so I'll just explain them real quick to make sure you really understand. Now, what is a position? A position is when you open a trade in the market. Closing the trade will simply mean closing your position. Now, what is a bid price? A bid price is the current price of a pair when you want to enter a buy position, while the ask price is the current price of a pair when you want to enter a sell position. As for spread, it's a topic itself, so I'll be covering it later in the next chapter after talking about pips. Okay, back to pips. Now, before I diverted, I was talking about how pips are important because traders use them to calculate the spread between the bid and ask price of the currency pair. So basically, most major currencies define a pip as the fourth decimal place. So one pip change is equivalent to 0.0001. But there are some exceptions, such as the Japanese yen, where a pip is the second digit after the decimal point. So let's take a look at the Euro-USD currency pair. Say the current price of Euro-USD is 1.0400. Now, if the market moves from 1.0400 to 1.0401, that 0.0001 increase will be a single pip move. So if you had entered a buy position in Euro-USD and the market moved from 1.0400 to 1.0450, you would have gained 50 pips and profited from the increase. But if the market moved against you, falling from 1.04 to 1.0350, this will simply mean that your position made a 50 pips loss. Now let's take a look at the USD-JPY currency pair. A move of 156.25 to 156.26 will be a single pip move. Now say you decide to enter a buy position on the USD-JPY and the price increased from 156.00 to 156.08. This means that the market has moved by 8 pips and your position will be showing a profit. It's very simple. Now, what is a spread? A spread is the difference between the price at which you can buy and sell a currency pair. It's basically the cost of trading and is built into the price of every trade. You can think of it indirectly as a fee you have to pay every time you get into a trade. So how is the spread calculated? First, you find the price at which you can buy the currency pair, which is the bid price. Then you find the price at which you can sell the currency pair, which is the ask price. Then you subtract the bid price from the ask price. So for example, say you want to calculate the spread for Euro-USD. Now let's say the bid price is 1.0405 and the ask price is 1.0400. Subtracting the bid price from the ask price will give you 0.0005. So basically, your spread is 5 pips. It's very simple. Okay, so what is a lot size? A lot in forex trading is the unit of measurement that standardized trade size. So say you want to risk about $100 on USD. Before you can execute your position, you have to calculate your trade size in lots. Okay, so as you know, the change in the value of one currency compared to another is measured in pips, which are the 4 decimal place and therefore are very tiny measures. This basically means trading a single pip isn't viable because it's very small. So lots exist to enable people to trade this small movement in large batches. Now lots are subdivided into 4 sizes. We have the standard lot, we have the mini lot, we have the micro lot, and the nano lot. The standard lot has 100,000 units, the mini lot has 10,000 units, while the micro lot has 1,000 units, and the nano lot has 100 units. Now if the Euro-USD exchange rate was $1.5, one standard lot of the base currency euro would be 150,000 units. This means at the current price, you'd need 150,000 units of the core currency USD to buy 100,000 units of euro. Now this might look very technical, but I'll show you it's going to be very easy to calculate when you start trading. Now what is a leverage? A leverage is a way to control larger positions than your account balance by borrowing money from a broker. Leverage is expressed as a ratio such as 10 to 1, 50 to 1, 100 to 1, and so on. Now, how does leverage work? First, it deposits funds into a margin account. The funds act as collateral for a loan from the broker. You can use the loan to open a position that's larger than your account balance, but you should know you are responsible for repaying the loan plus interest if you keep the position overnight. Now, keeping the position overnight is called swap. So basically, it's possible to trade with $100,000 with just an account balance of $1,000. That's a 100 to 1 ratio. That's how powerful leverage can be. Now, if you're following, you probably know that the extra 99K is being offered to you as a loan from the broker. But you should know the brokers most times charge commissions, which are fees. It's usually a very small amount, so you don't have to worry. Now, what are the risks of leverage? Leverage can increase your profits, but it can also increase your losses. So basically, it's a double-edged sword. Using high leverage with small account can be very risky. Now, there are some people in trading we call flippers. Flippers are people who flip their small account balance into a large account. So sometimes you can see a flipper turning $50 into $5,000 in just a very short period of time. Now, this might look cool, but the fact is that at least 95% of flippers always end up blowing their accounts. So again, it's very risky to use high leverage for a small account. I recommend using nothing more than a 1 to 100 leverage ratio if you are starting as a beginner. Now, the last risk of leverage is if the market moves against you, you could lose more than you invested. It's that simple. Okay, so what are the tips for using leverage? New traders should limit their leverage to 100 to 1 and below. Before you start trading, understand the leverage ratio and what it means. Now, this is very important. Before you start trading with real money, I advise that you trade using a demo account for at least 2 weeks. Now, a demo account is a virtual account you can create for free from any broker out there. Starting your trading journey with a demo account is a smart way to understand the trading environment. Now, lastly, be aware that leverage magnifies both profit and losses. So whenever you want to enter into a trade, there are always 3 levels you need to set in the market. Number 1 is the entry level, number 2 is the stop loss level, and number 3 is the take profit level. Now, let's say you have about $1,000 in your account and you want to take a buy position on GBP USD. Now, obviously, it's not wise to risk all your funds on a single trade. So after setting the buy limit entry level, it's necessary to set a stop loss below the entry level just in case price goes against you. Now, your take profit level is simply the level you exit the market. Okay, so who is a broker? A forex broker is a company or a person who helps clients to buy and sell foreign currencies. They act as intermediaries between the buyers and the sellers and are paid a commission for their services. How do forex brokers work? Brokers take orders from clients to buy or sell currencies. They execute these orders from the OTC market. They may also provide market research and market data. Okay, so how do forex brokers make money? They make money from commissions, they make money from spreads, they make money from overnight funding, which are called swaps, and they make money from other fees as well. Okay, so there are a lot of forex brokers out there, by a lot, I mean thousands, but there are some that are well known in the forex industry for the unique offers. We have IC Markets. IC Markets is the largest forex broker by trading volume. We have Pepperstone. Pepperstone is a good choice for advanced traders. We have CMC Markets. CMC Markets is a good choice for very active traders. We have Forex.com, we have LBS, we have XM, we have AvaTrade, we have XTB, and many more, just to list a few. Now, I personally feel like forex trading is a discipline entirely on its own. So just like any other discipline, you need tools to execute. So I'll be sharing with you 4 major tools you have to learn to use to become a forex trader. Without even one of them, you're literally incomplete. Now, number 1 is the Metatrader. It could be Metatrader 5 or Metatrader 4. Number 2 is Forex Factory. And number 3, we have the position size calculator. And number 4 is Tradingview. Okay, so this is Metatrader 5. Metatrader is a trading platform that allows users to buy and sell assets like stocks, commodities, and currencies. It's basically the most popular platform to execute trades for forex traders. So this is the MT5 version. We have 2 types of version. We have the MT5 version and we have the MT4 version. Well, I prefer using the MT5 version along with other forex traders because it's just way better than the MT4 version. Okay, so the way it works is whenever you want to start trading, you register an account with a broker. So you get the login details of that account and you come on to MT5 and you log in into MT5. So basically the main purpose of the MT5 is to execute trades. So this is not where you create your account. This is not where you analyze. This is just where you come to execute trades. So I'm going to be explaining this better later in the video, but I just want to show you how this works, okay? So we have different charts right here. We have the bar chart. As you can see, it's quite different from the candlestick chart. We have the candlestick and we have the line chart as well. But I prefer using this. I recommend using this because this has more details compared to other types of charts. So right here we have the time frames. As you can see, this is the 1 minute time frame. This is a 5 minute time frame. This is the 50 minutes. This is the 1 hour. This is the 4 hour, the daily, the weekly, and the monthly time frame. So all these right here are tools, you know, by which you can use to analyze the charts, right? We have the trend line. So if I just come over here and drag, so you can see, you can use this as a way to analyze the market. So we also have other tools as well. You can see the rectangle. So if you want to highlight a certain section, just do it like this. It's very simple to use. Okay, this right here is a button. So in case you want to, you know, get into multiple trades at once, so this is how you do it. So if you want to execute a lot of trade at once, you can just simply do it using this single button. Okay, so we have the new order. So whenever you want to place a new order, maybe you want to buy or you want to sell, just click on this new order right here. So you go over to the section. So we have different types of execution. We have the instant execution. So what this basically means is if you want to buy at the current market price, okay, so you just put in your lot size right here, you put in your stop loss, you put in your take profit. So once you click on buy or you click on sell, your order is automatically going to be executed, meaning your entry price will be the current market price. So that's it for instant execution. Okay, we also have the buy limit, we also have the sell limit, we also have the buy stop limit and the sell stop limit. So basically the buy limit simply means, let's say you're trying to buy a currency like USD, then price has gone all the way up, but you know price is definitely going to come down before it continues the bullish momentum. So you enter a buy limit. Okay, so buy limit is always below the current market price, while sell limit is always above the current market price. Now buy stop and sell stop simply means when, okay, let's say you're trying to buy a currency, okay, then price has gone all the way down, you know price is definitely going to go all the way up, so you set your buy stop above the current market price. Now for sell stop, it's going to be below the current market price. We also have the buy stop limit and the sell stop limit, but a lot of people don't actually use that. You just have to know how to use the buy limit, the sell limit, the buy stop, and the sell stop. Okay, we have this plus sign right here, and this minus sign right here is basically just a way to, you know, zoom in and zoom out. It's very simple. So we have this right here. This is the indicator. So in case you want to just add any indicator to your charts, again, this is not the platform where you analyze your charts. I'm going to be giving you a site where you're going to analyze charts. This is just mainly for execution, but I just have to explain this right here so you actually know the potential of this platform. So these are indicators. You can just add any indicators you want to add, but I prefer leaving it just like this. Okay, this right here is the economic calendar. So in Forex, there are sometimes, you know, news affects and influence on the market. So if I click on this right here, you can see different flags. This is the Aussie dollar, the Australian dollar JPY, and as you can see, this is the Japanese flag, this is the Australian flag. So at this moment in time, the news influence the market, meaning, let's say for instance you're trading like Euro USD during the time of maybe Trump inauguration, things like that, those kind of news, it really affects the market. So you have to know whenever a news is going to come up so you don't get stopped out just by sudden volatility. It's very simple. But this is not actually where you check on the news. I'm going to be giving you a site where you can check the news in more detail. Okay, now you can also come down to the section as well. So whenever you check a trade, the trade is going to appear in this section right here. So you can just simply click on create new order and you can see all these parameters right here. You can see the symbols, you can see the ticket, the time, the type, the volume, the price, the stop loss, take profit, the price swap, and different types of other parameters like the margin and the equity. You can see my equity right here is $10,000 because this is demo account. Okay, if I go over here, you can see this is actually a demo account. This is not a real account. Okay, so you can also check out your history as well. If you want to check out your history, just come over to the section right here. So whenever you place a trade, every single trade you've ever taken is going to appear in this section right here. So maybe you want to reflect on your trading, you want to know how far you're progressing. You can just come over to the section right here and check your history. It's very, very simple to use. So like I said earlier, in forex trading we have something called news, and this thing called news sometimes affect and influence the market one way or another. So you have to know when the news of the day will happen, so you can always be prepared. So whenever you want to check out news, you come over to forexfactory.com. So as you can see in Forex Factory, there are a lot of things you can actually do, all the way from forums to trades to news, calendar, markets, brokers. But the main thing you want to actually get from this website are the news. So just go over to calendar right here and click on calendar. Okay, so you can actually see we have different types of news from different types of currencies, but there's something really super important you have to do before checking out news. Okay, so you go over to filter. Okay, so when you go over to filter, I want you to pay close attention right here. So we have different types of impact news. So this is the high impact news, this is the medium impact news, this is low impact news, and this is a normal impact news, just like the weak impact news. So there are different types of news. We have some news that may influence the market more than the others. So that's what this just simply means. Okay, this is the high impact news, this is the medium impact news, this is normal impact news, and this is low impact news. So what you want to do is to remove this low impact news and the normal impact news, and I want you to leave this high impact news and medium impact news right here. When you go over to event types, we have different types of events, all the way from growth to inflation to customer survey. So I want you to leave all this right here and go over to currency. Now, if you're somebody that trades, let's say you only trade Euro USD, right? You don't actually need all news from different currencies. You only actually need news from Euro and news from USD. Okay, now if you're somebody maybe that trades multiple currencies, you only have to check out news that are pertaining to those currencies, right? Okay, let's say for example I trade only Euro USD, so I'm just gonna remove the rest of this right here, because I don't want to be bothered by the news from other currencies. So I only need news from Euro and news from USD. I'm going to click on apply filter. Now you can see I only have news from Euro and USD. Okay, now whenever you come over to the calendar section, this is what I want you to do, to go over to the filter section and try to do that send. So it's very simple. Now you can see all these news are actually updated. So this happened on March 3, all the news happened on March 3, this happened on March 5. But when I scroll down, you can actually see on the more button. So when you click on this, you can actually see the rest of the news for the rest of the month of March. Okay, so you can actually see all these news have very powerful news. These news are all high impact news, except this is the medium impact news. So whenever you want to take a trade, you have to come over to Forex Factory. Okay, so now let's say you want to take a trade. Let's say you see a trade setup right on the chart. You analyze the chart, you see a trade setup. So you want to take a trade maybe by 2 p.m. and you come over to Forex Factory and you see that it's actually going to be in news by 2 p.m. You don't take that trade. You do not go into that trade. It's until after the news plays out, that's when you get into the trade. Because if you end up getting into a trade, you might actually be stopped out due to high volatility. Okay, so that's very important. So you always have to come to forexfactory.com to check out if any news is going to play out. It's very simple. Okay, so this is myfx.com. It's one of the most popular websites to calculate lot sizes. Now, whenever you want to get into a trade, you always need to calculate your lot size. Now, for example, let's say you have about $1,000 in your account and you want to risk, say, 10% of your equity into a trade. In order to know how many lot size you need to use, you have to use a calculator. So basically, just come over to this site which says myfx.com in order to calculate your lot size. Now, the way it works is very simple. You have your currency pair right here, so you can literally change this to any other currency aside from your USD. Now, let's say I want to change it to another currency like GBP JPY. Okay, there you have it. We also have the account currency. Say you want to change it to a currency aside from USD, you can just change it to Euro, you can change it to Swiss franc, to Canadian dollar. But I'm just going to leave this in USD. Now we have the trade size, the lot. Now this section is very important. This is the section where you input your lot size. Now this is the open price, this is the close price. The open price just simply means your entry level. Now this is where you put in your entry price. This is where you put in your stop loss. Now if you want to buy, you just click on buy, but if you want to sell, you click on sell and then you click on calculate. It's very simple. Okay, so I should let you know this is not the only lot size calculator out there. I personally don't even use my FX book, but if you are a beginner in forex trading, myfsb.com is a good way to start your journey. Okay, so this is Tradingview.com. This is the number one platform in the world where you get your charts. This is basically where you come to analyze the market. You can actually analyze using MT5, but Tradingview is just way better. It's more advanced and more user-friendly as well. Now, what makes Tradingview very popular is because it has almost every tradable financial instrument, from Forex to futures to crypto to stocks, indices, even bonds and ETF. So let's say, for example, you want to check out a currency pair like Euro USD. Just come over to this search button right here and just click on search and just search for Euro USD. Okay, now we have different options, so you can just simply click on any of the options right here. So I'm just going to click on this or click on launch chart. And as you can see, this is the 4-hour chart of Euro USD. We have our tools right here, just like MT5, but unlike MT5, this has way more advanced features. Okay, now you can see this is the trend line, but when I click on this right here, you can see this has different types of tools that you can use that you're never going to find on MT5. You can see the trend line, you can see the ray, you can see the if line, the SN line, the trend line. Okay, so if I come over here, you can see we have different Fibonacci, tools. We also have patterns. We also have different patterns. You can see the cipher pattern, you can see the head and shoulders, but I don't actually personally use these patterns because I don't trade retail. I only trade ICT. I don't trade retail, but many retail traders actually use these tools right here. Okay, so we have our time frames. This is the 1 minute time frame, this is a 5 minute time frame, this is a 15 minute, this is a 1 hour. We are currently in the 4-hour time frame. This is the daily time frame, this is a weekly, and this is a monthly. Now, in case you want to change your charts, we are currently on the candlestick charts. This is the hour candles, this is the volume candles. Now on the MT5, when we check the MT5, there were only about 3 types of chart on the MT5. But on Tradingview, you have different types of charts, right? You have different types of charts. You can see the HLC, you can see the step line, you can see the line markers, but I'm just going to leave this on candlesticks. Okay, so when I come over to indicators, you can actually search for different types of indicators. They have every single indicator you can ever think of. They have every single thing. You can see I personally have 2 indicators that I've added on favorites. You can simply just add any indicator on favorites, and you can just simply go over. Whenever you add any indicator on favorites, you're going to simply go over to the session. You can see I have the sessions and I have the fractals. So it's very simple to use. We also have the alert as well. Let's say you want to take a trade, but you're waiting for price to get to a certain level, right? And you can just simply add this alert right here. So when price comes to that level, you're going to be notified. So it's very simple. We also have the play mode as well. Say for instance, you're trying to backtest, okay? So you can just simply click on the play mode and you can just see the market replaying itself. So it's just a way to backtest the market. Now you can see these tools right here. These are all tools that I've added to favorites. So these are tools from this section right here, but I've added them to favorites. That's why you can see them here. So when you get into the chart, you want to start analyzing charts, you don't have to go to all these tools anymore. You don't have to search for different tools. You can see I've added the hours on the line, I've added the hours on the ray, the vertical line. These are tools I use every single day. Okay, so you can just simply add them to favorites and they are going to appear in this section right here. Okay, so let's talk about time frames. What are time frames? A time frame simply refers to a specific period of time used to analyze price movement on a chart, essentially representing how long a candlestick on the chart represents, whether it be minutes, hours, days, weeks, or months, allowing traders to identify trends based on chosen time frame and make trading decisions accordingly. Different time frames provide different perspective on market behavior, with short time frames showing more detail and longer time frames revealing broader trends. So what this simply means is, in order to get a long-term perspective on the market, you have to use the bigger time frames. By bigger time frames, I mean the 4-hour, the daily, the weekly, and the monthly. So in order to add more detail in the market, you need to use the smaller time frames. By smaller time frames, I mean the 5 minutes, the 15 minutes, the 30 minutes. And these are majority all the time frames we have. If I click on this right here and I scroll down, you can see we have up to like 12 months. That's very, very crazy. We have 6 months, we have 3 months, we have 1 month, we have 1 week, and we also have other several minutes as well. We even have seconds. So time frame is basically just to understand the market in different perspective. If I go into the 1 month time frame, the perspective I'm going to have will be different if I use a 15 minutes time frame. So it's very simple. Now this is a Euro USD. Let's now go on to the 1 month time frame. Also, on the 1 month time frame, you can see this is a bigger perspective. right? This is a bigger perspective. Every single candle you see on this chart represent 1 month of trading data. It's very, very crazy. This candle represents 1 month. This candle represents 1 month. This candle represents 1 month. These three candles together, these three candles, this right here, it's 3 months worth of trading data. So it's very crazy. So now you have a perspective on the monthly time frame. So whenever you want to analyze your trade, you don't just go onto the 5 minutes, you don't just go onto the 15 minutes or the 1 hour and start looking for a setup. You have to go to the higher time frames to have a bigger perspective. Now there are 3 core principles of a good strategy. We have the bias, we have the range, and we have the entry. In order to get your bias, you have to go onto the higher time frame. You have to go onto the higher time frame to get your bias. In order to get a range, you can either use a small time frame like 15 minutes, or you can use 1 hour. You can even use a bigger time frame for your range. Okay, now let's say you are a day trader, right? You use the 1 hour time frame to get your bias, you use the 15 minute time frame to get your range, and use a 5 minute time frame to get your entry. But nevertheless, you still have to go onto the higher time frame, onto the higher time frame like the 1 month, the 1 week, the daily, in order to have a bigger perspective. Okay, so it's very simple. Now let's refine down to the weekly time frame. So now you can see on the weekly time frame, I have a different perspective from the monthly time frame. Okay, if I go down to daily time frame, so as you can see on the chart, price has been coming all the way down, and all this right here is a consolidation. So price has been reversing all the way down. This is an expansion, a bearish expansion, and price consolidated. Consolidation simply means when price stays in the same position over a long time. And now we are in a reversal. Okay, price has started to go bullish. So price came all the way down, price expanded all the way down. Okay, and there was a consolidation, and now price is in the reversal. Now price is on a bullish trend. So it's very simple to get your perspective. It's very simple. Now mind you, this is a daily time frame. Okay, in order to get into a trade, if you are maybe say a short-term trader, if you are maybe a day trader or a scalper, this is where you get your perspective. Before going on to the 5 minute, before going on to the 15 minutes, this is how you get your perspective. So you know now Euro USD is on a bullish trend. This is the reversal on the daily time frame. Okay, now let's refine down to the 4 hour. Let's see if we can find instructions. Okay, so this is the 4 hour time frame. Okay, now you can start to see different structures. You can start to see a lot of structures. So if I delete this right here, you can actually see price is just, going up, coming all the way down, going up, coming all the way down. So in all this movement, if you actually go to the lower time frame, like the 5 minutes, like the 15 minutes, you will actually see some trade setups in the 4 hour. So it's just that simple. It's not really hard. So you just have to practice, in order to understand how the time frames actually work. You don't actually understand your first trial. You have to keep refining, keep practicing. You have to keep back testing, going back 6 months, going back 1 month into the chart, looking at how the chart is in order to understand how to use your time frame. But you just have to know the time frame is very, very, very important. You have to get your bias first, you have to get your range, and you have to get your entry. Now you get your bias, like I said, you get your bias using the higher time frames, you get your range, you can either use the higher time frames or the lower time frames, and you get your entry using the smaller time frames. So it's very simple. Now we're going to go back real quick to our whiteboard. So based on time frames, we have 4 different types of trading. We have the position trading, we have the swing trading, we have the short-term trading, we have the day trading, also known as scalping. Position trading in Forex is a trading strategy where a trader holds a position in a currency pair for a very long period of time, usually spanning weeks, months, or even years. They aim to profit from significant long-term trends rather than short-term price fluctuations. Essentially, they take a position in the market and stick with it for as long as the trend persists. So who are position traders? The position traders are the institutional banks like JP Morgan, Goldman Sachs, Morgan Stanley, and so on. We also have hedge funds as position traders as well, and we also have long-term individual investors. Now, what are the time frames used by position traders? We have the 1 month time frame, we have the 1 week time frame, and the daily time frame. They use the 1 month time frame to get the bias, they use the 1 week time frame to get a range, and they use the daily time frame to get the entry. Now, what is swing trading? Swing trading involves buying and selling of currency pairs over a period of days or weeks to profit from price fluctuations. They hold position for a longer time compared to day traders. Now, what are the time frames used by swing traders? We have the daily time frame, we have the 4-hour time frame, and we have the 1-hour time frame. They use the daily time frame to get a bias, they use the 4-hour time frame to get a range, and they use the 1-hour time frame to get an entry. Now, what is short-term trading? Short-term trading in Forex is the practice of buying and selling currency within a short period of time, usually hours or days. Okay, so what are the time frames used by short-term traders? We have the 4-hour, we have the 1-hour, and we have the 15 minutes. They use the 4-hour to get a bias, they use the 1-hour to get a range, and they use the 15 minutes time frame to get the entry. Now, what is day trading? Day trading, or scalping in Forex, simply means buying and selling currencies within the same trading day, aiming to profit from small price fluctuations by opening and closing positions multiple times throughout the day, rather than holding positions overnight. So what are the time frames used by day traders? We have the 1-hour, we have the 15 minutes, and we have the 5 minutes. The day traders use the 1-hour to get a bias, they use the 15 minutes time frame to get a range, and they use the 5 minutes time frame to get an entry. Now, what are trading sessions? Forex trading sessions are the times when Forex market is active and trading is taking place. Now, the Forex market is dividing into 4 major sessions. We have the City session, we have the Tokyo or Asia session, we have the London session, and we have the New York session. Now, how does Forex trading session work? Each session is based on the opening and closing times of major financial centers. Each session has its own characteristics, which are influenced by the market operating during those hours. For instance, the market is most volatile during the New York session, so a lot of people prefer trading during the New York session. The Forex market trades continuously from Monday to Friday, but the Forex market is always closed on weekends. But from Monday to Friday, 24/7, trading is always active. Now, before I talk about trading strategy, I need to let you know that there are 3 fundamental skills you need to master to become a profitable and successful Forex trader. Number 1 is trading strategy, number 2 is trading psychology, and number 3 is money and risk management. Now, what is a trading strategy? A trading strategy is a plan that helps traders to decide when to buy or sell a currency pair. It involves analyzing the market to determine the best entry and exit points, as well as the position size and trade timing. Now, based on my experience over the years, I've come to the conclusion that a good trading strategy must have 3 basic and fundamental principles. On the number 1 list, we have the bias. Bias simply means to know where the price should go next from its current position. Now, on the number 2 list, we have the range. Now, whenever you want to find a trade setup, you don't just get into the charts and start analyzing. After getting your bias, you need to find and highlight the range by which you will use to get into the market. Finding a range simply means you're looking for market structure in the charts. Now, lastly, we have the entry. So after getting your bias and your range in the market, with a good strategy, you should be able to get an entry in the market by which you can use to enter the market. Okay, so we have 4 major trading strategies. We have the candlestick patterns, we have the technical analysis, we have the SMC or ICT. SMC basically stands for smart money concept, and we have the algorithmic trading. Now, what is trading psychology? Trading psychology is the emotional and mental state of a trader that affects their decision in the financial markets. It's a key factor in determining whether a trader is successful or not. Now, why is trading psychology very important? It helps traders understand how emotions can affect their trading. It helps traders develop discipline and avoid impulsive actions. It helps traders manage risk and control their emotions. Now, how can traders improve their trading psychology? In order to improve your trading psychology, you have to develop self-awareness. Now, this simply means understanding your strength and your weakness. Number 2 is practice mindfulness. From time to time, you have to take breaks to reflect on your trading. So let's say you take a lot of trades from Monday to Friday. Now, on the weekend, you can just simply reflect on your trading. So by reflecting on your trade, you're going to know if you're trading too much, if you're trading too much currency pairs, and things like that. Now, number 3 is to establish trading rules. You have to follow a trading plan and stick to it. Okay, so now I feel I should let you know this. Very, very few people teach all this stuff on YouTube. Most just give you a trading strategy and that's it. But a trading strategy is only a piece of the pie. You really need to master all this to become a profitable trader. In fact, most of you are probably going to still come back to this video after starting your trading journey. I feel like it's until you start to trade, that's when you understand how important psychology is in trading. Okay, so what is money and risk management? Money and risk management refers to the practice of strategically allocating your trading capital and actively minimizing potential losses by setting limits on how much you can risk per trade. Now, what are the key aspects of money and risk management? Now, on the number one list, we have the risk per trade or position sizing. Now, the standard percentage everyone believes we should risk for every trade is 2%. But I personally feel that the level of risk you take per trade should depend on your strategy. Like me personally, for instance, I risk just 0.5% of my equity for every trade that I take. And that's simply because I use preference to trade. But I could risk up to 5% per trade when I'm using my own funds to trade. But the point I'm trying to make at the end of the day is that you, as a beginner trader, shouldn't risk above 2% per trade. It's a management rule that will help you last long in the Forex game. So on the number two list, we have the stop loss order. Number three, we have take profit order. And number four, we have risk to reward ratio. Now, why is money and risk management important in Forex? Now, money and risk management protects your capital, it gives you psychological stability, and it makes your trading sustainable. Okay, so this is Excellence.com. Excellence is one of the best and most popular Forex broker. It's the best broker I can recommend for any beginner Forex trader. I personally use Excellence myself, so as you can see, it's very simple to use. So if you want to create an account, you can either go to this boy right here, which is open new account, or you can just come over to the section right here and click on open new account. Okay, first off, you can either create a MT5 account or MT4 account. As you can see, the MT5 account is recommended, so I advise in creating the MT5 account. And as you can see, they have different versions, right? They have the standard version, they have the pro version, they have the raw spread. And if I take this, okay, you can see they have the zero version and the standard cent as well. But of all this version, this is most recommended. This is the most recommended, okay? This is the starter version. So just go for the starter version right here. Just click on this and just click on continue. One of the reasons this is the best version is because the minimum deposit is just $10. Why for the pro is about $500. So if you have over $500, you can just go for the pro. But if you're going to make a deposit of over $500, advising using zero, because zero is way better compared to pro right here. So you can see the spread for zero is just zero spread. Why for the pro is 0.1. So the zero is better compared to the pro if you're going to deposit anything over $500. But just for the sake of the video, I'm going to be clicking on standard. Okay, I'll click on continue. Now as you can see, we have the demo and we have the real. We're trying to create a real account, so I'm just leave it on real. Okay, now this is the max leverage. The max leverage is currently 1:2000. Now, like I said, if you are a beginner Forex trader, I do not advise going for anything above 1 to 100. Okay, so this is currently on 1 to 2000. If you are a pro trader, you can just go for 1 to 2000. You can go for 1 to 1000. But if you are a new trader, you first have to start from at least 1 to 100 and below. So I'm just going to click on 1 to 100. Okay, we have a currency in US dollars. I'm going to leave it in US dollar, and you can just put in your nickname right here and your password, and you're going to click on create an account. Okay, so as you can see, we just created an account. This is the MT5 account, this is the third version, and this is the real account. Currently our balance is zero. Okay, now say you want to make a deposit, right? You want to deposit into your account and start trading. So how do you do that? You can either click on this deposit button right here, or just simply go to the deposit section. And as you can see, there are different ways to make a payment into the platform, right? There are a lot of ways to make a payment into the platform. We have the bank transfer, we have the bank card. You can make a deposit using Bitcoin, you can make a deposit using Metatrader and other payment methods as well. Now, the average minimum deposit is about $12. You can see for the bank transfer, it's about $12. The maximum is about 10K. For bank card, the minimum is about $10. The maximum is about 10K. For Bitcoin, the maximum is about 200K. And for Metatrader, is about 50K. So it's very simple. So you can choose any payment method right here and make a deposit. Now, say you've made a deposit and you now start trading and you make a profit. So how do you make a withdrawal? In order to make a withdrawal, you just simply go to the section right here. And as you can see, just like the deposit section, we also have different payment methods. You can withdraw using your bank, you can withdraw using USDT, you can withdraw using Bitcoin, Nether, whatever payment method, even Skrill. But of all these payment methods, I prefer using USDT because it's way easier. Now you can see for the online bank, the minimum withdrawal is $3. You can withdraw as low as $3 from this platform. So it's very, very cool. For Nether, it's about $4, while for Bitcoin, it's about $200. But for USDT, the minimum withdrawal is about $10, while the maximum is about $1 million. So you can withdraw $1 million from this platform. So this platform is very, very, very good for any trader. I really, really recommend Exness. This is one of the best brokers you ever gonna find out there. Okay, now let's say you've made a deposit. Now you want to start trading. How do you start to trade? You don't actually trade in this platform, okay? So whenever you create your account, what I want you to do is to go to this section right here and click on this, and you're going to see your MT5 login. So what you're simply going to do is that you're going to log in this account into MT5. Now this is your MT5 login. So you're going to copy this number, and you're going to use the password which you used to create the account on the MT5. So you're going to copy this number, go to MT5, paste the number on the login section, and you're going to import the password as well, which you used to create this account. And I want you to come over this section right here. This is very, very important. This is the server code. So when you go over to MT5, you're going to put in your login, you're going to put in your password, and you're going to have to select a server, right? As you can see, my server's name is Exness MT5 Real 30. Your 30 could be 10, your 30 could be 15, it could be 11. You really, really have to be careful and make sure the server name is correct. Okay, so now when you go onto your MT5 app, you're going to see a button where it says add new account. When you click on new account, you're going to have to search for your broker. So you're going to search for Exness. Now, as you can see, there are different options. There are a lot of options from Exness. You can see this is Exness SC. You can see this is Exness CY. You can see this is Exness KE. There are a lot of versions, right? But the one we're actually going to use is this right here, Exness Technologies. So I'm going to click on Exness Technologies. Okay, so now you're going to put your MT5 login into the login section. You're going to input your password in the password section. And you're going to have to confirm whether the server name is correct. As you can see, this is currently Exness MT5 Real 10. And my server's name is Exness MT5 Real 30. So I have to look for Exness MT5 Real 30. Okay? Yeah. So there we have it. So after confirming your server's name, you're just going to click on login. And as you can see, I'm currently logged into my account. The account balance is currently 0. You can see this is standard. This is the account we created a while ago, right? So if you want to take a trade, it's very simple. Just go over to quotes. And as you can see, we have different currencies right here, okay? So you can just simply add any currency you want to add. Let's say you want to add your USD. So this is your USD. Now as you can see, your USD is added to the list. And you can also delete some currencies as well. Okay, let's say you want to delete. Just click on this right here. And you're going to select, let's just say we want to delete every single currency pair here except the Euro USD. Now, there we have it. So you can add as much currency pair you want. And come over to trade and just click on the plus one right here and place your order. It's very simple. Okay, so this is USD and this was a trade I got to recently about some weeks ago. So I'm going to be showing you how I got my bias in this trade, how I got my range, and how I was able to enter into this trade. Now, first off, how did I get my bias? Now let's go on to the weekly time frame. I got my bias from the weekly time frame. Okay, let's go to the weekly time frame. So you can see we have a bigger perspective, right? So a trade I took was around this area right here. So this is how I got my bias. So I knew price was going all bearish, right? So price has gone all the way up, price came all the way down, price went up, and price was on a bearish momentum. So I knew price was going to definitely go below this low right here. So how did I know price was going to go below this low? Because this low is basically a liquidity. Now, what is a liquidity? So this simply means when price does not break any structure on the far left side, this low automatically becomes a liquidity. So I knew price was going to come below this low. So that was how I was able to get my bias. So essentially, I used this low as my TP. Okay. I use this low right here as my TP. So how did I get my range? Now let's go on to the 1 hour time frame. Okay, now on the 1 hour time frame, this is the range I used to get into the trade. This range right here. Okay, this right here and this right here. So I use this structure to get into the trade. This structure right here. So this was my range on the 1 hour time frame. Okay. Now I knew price was gonna go bearish, right? I knew price was gonna go all the way down. Now, as price was coming all the way down, as price was on a bearish momentum, price came down, went up, came down, went up. So I knew price was going to go all the way down, right? And price started coming all the way down, and there was a small retracement right here. And price came all the way down. There was a sudden bearish move downward, and price went above this high right here. So this basically is a liquidity. So on the 1 week time frame, I show you what liquidity is, right? Whenever price does not break any structure on the follower side, it automatically becomes a liquidity. So this I right here is a liquidity. Why? Because it does not break any structure on the follower side. The follower side meaning this range. So this is a structure I used to get into the trade. So this high did not break any structure on the follower side. So automatically it became a liquidity. So I knew price was going to go above this high right here. So immediately price went above this high, I started to look for an entry. So how did I get my entry? Now let's go on to the 15 minutes time frame. Okay, so now on the 15 minutes time frame, so you can see this is the high, which I call a liquidity, right? Price went above this high, then I started looking for an entry. So basically, after price went above this high, there was a stepping breaker. So I have a video about the stepping breaker concept. You can just check that video out after watching this video. So basically, the way the stepping breaker works is very simple. Now, on the bearish momentum, when price breaks too low, okay? When price breaks too low, this order block automatically becomes a stepping breaker. So this means this order block becomes a valid order block. It becomes a stepping breaker. Why? Because it broke too low. Now, on a bullish scenario, when price breaks too high, it automatically becomes a stepping breaker. It's very simple. So this is how I got my entry. So there was a stepping breaker, there was a break in market structure, but unlike ICT's breaker structure, this is a stepping breaker because price broke two lows. So it's very simple. So that's how I got my entry. Now let's try to see how many risk to reward ratio. I think it was about 1:6. Okay, should be about 1:6. Let's try to go back to the 1 week time frame in order to get the TP, the take profit. Okay, let's start to take a closer look and get a definite TP. My TP was 148,645. Okay, now let's go back to the 15 minutes time frame. Okay, so this right here is my TP. This was the TP. So this right here is the take profit, also known as the TP. This right here was my entry level. Okay, this right here is the stop loss. So it was about, I think, 1:6. Let's try to refine down. Okay, right now I think it's about 1:5.81. Let's try to take it down a bit to make it 1:6. Let's try to get a definite number. 149,791. Let's make it 790. Okay, so now let's say you want to get into this trade. So if you want to get into this trade, how do you do it? How do you get into this trade? It's very simple. First, you go over to myfx.com, okay, and you're gonna put in your entry price right here, and you're gonna put in your close price right here. Now, if I go back, you can see that the entry price is 149,785, while the stop loss is 149,980. Okay, so now we've entered our open price and we've entered our close price. Now, say you have about $1,000 in your account, right? And you want to risk, let's say, on 5% of your equity, which is $50. So you're going to find the lot size that's equivalent to $50. So how do you do that? First, you go over to direction. Now, currently we are trying to sell, not buy. So this is currently on the buy. You click on sell right here and you click on calculate. So as you can see, if you put in one lot size, you're going to lose $132 on your $1,000 account. Okay, so we have to look for the lot size that's equivalent to $50. So let's try using 0.3 lot size. Okay, we'll click on calculate. So as you can see, this is about $39. So I'm just increase to 0.35 lot size. Let's see if we get to $50. Okay, this is $46. Let's increase to about 0.37. Okay. Okay, so it gave us $49. So let's try 0.38. Let's see if we can get to that $50 mark. Now we got our lot size. So if you want to get into this trade and you want to risk 5% of your $1,000 balance, you're going to have to use 0.38 lot size. So after getting your lot size, you're going to go over to MT5, right? You're going to go over to MT5 to place your trade. As you can see, there's no USD JPY right here. So we just have to add USD JPY. I'm going to click on Forex. I'm going to scroll all the way down. Okay. Let's try to look for USD JPY. Okay. And this is USD JPY. Click on this, click on cancel, and you can see this has been added. Okay, we'll click on USD JPY. Now there's one thing that's really important. Always make sure this right here tallies with this right here. You do not want to enter the wrong numbers on the wrong currency pair. You really have to make sure this always tallies with this right here. Okay, with that being said, let's try to place our order. So I'm going to click on new order right here. Okay, so in this section, as you can see right here, this is currently on the instant execution. Now, as you can see, if I go over to Tradingview, you can see this is a sell. Okay, so we're going to enter a sell limit. Why are we going to enter a sell limit? Because price came all the way down and we're trying to enter a sell. So we're going to place our entry level above the price level. Now we are assuming this was a live trade. Let's say the price of the market at this current time was around this level. So you're going to place your sell limit above this level. So you know price is going to retrace into your zone. Price is going to retrace into your entry level before you start going all the way down. So you have to enter a sell limit. So I'm going to change this instant execution to a sell limit. Then you're going to go over to myfxbook.com. You're going to copy your lot size, you're going to copy your open price, and you're going to copy your close price, which is your stop loss. And you're going to go over back to MT5 and you're going to paste your lot size right here. You're going to paste your entry price right here. You're going to place your lot size. And if you like, you could bring your take profit right here, or you can just leave it and you're going to click on place order. It's very simple. Okay, so let's take one more example. This is gold, XAUUSD, but gold isn't actually a currency. Gold is a commodity, but I do trade gold. At least I trade gold about 70% of the time because I prefer gold compared to other currencies. So this is a trade I got into, right? This was about 1:10. Okay, so quickly, how did I get my bias, right? How did I get my bias? So I got my bias on the 4-hour time frame. Now let's go on to the 4-hour time frame. Okay, so on the 4-hour time frame, this, let me just highlight this right here so we have an idea of where exactly I took the trade. So this section right here is what we're going to talk about. Okay, so price has been going bullish. Okay, on the long term, if you go to the 1-month time frame, if you go to the weekly time frame on gold, price has been all the way bullish, right? So I knew price was on the bullish momentum on the higher time frame, right? So price went up, came all the way down right here, went up, came down, went up, came down a little bit right here. It was a retracement right here. This black candle was a retracement. Then price went up. So I knew automatically this low right here. Okay. This low right here was a liquidity. Okay, so why was this low a liquidity? This low was a liquidity because it didn't break any structure on the far left side. It's very simple. So basically it's a liquidity. So I knew price was going to come below this low right here. So another confirmation I had was using the PDR metrics. Now PDR metrics is just a concept by ICT. Now I'm not going to go into details about PDR metrics in this video, but basically the way it works is very simple. Now this red section right here is a discount and this green section right here is a premium. Now the color is actually subjective. Your premium could be red, your discount could be green. But anyways, the way it works is when price is on a bullish momentum. So price doesn't always go on a straight line. There always has to be a supply and demand. So price has to go up, down, up, down, up, down. So this basically is called expansionary retracement. So price expand all the way up, retraces a little bit. So it's like expanding, retracing, expanding, retracing. So there has to be this kind of movement in the market. Price doesn't just go on a straight line. Now, in order to know when the next retracement will happen, you need to use the PDRA concept. So it's very simple. So I know price is going to continue the bullish momentum because price has come into the discount level. So it's just that simple. So price came into the discount level and I knew it was going to continue the bullish momentum, right? So I knew it was on the bullish momentum. Now let's take a look at this right here. Let's take a closer look. So as you can see, price from this low right here, price went all the way up. Okay, there was a little retracement right here. This candle right here is a little retracement. So price came all the way down and price went up and price came below that low. Why? Because this is a liquidity as well. Okay, this is a liquidity. So immediately price came below this low, I started looking for an entry. I knew price was definitely going to go all the way up because this is a low. Now this is what you call a mitigation zone. So whenever price breaks a liquidity, right, in the market, this section, right, the area below that low automatically becomes a mitigation zone, or you call it a mitigation block, whatever, it doesn't matter. So this, you can call this a mitigation block, or you can also call all this right here mitigation zone. So price came into the mitigation zone. Immediately price came into the section, I started looking for an entry, right? I started looking for an entry. So I got my bias on the 4-hour time frame and I got my range also on the 4-hour time frame. So it's possible to get your bias and your range, even your entry, in the same time frame. So I got my bias on the 4-hour time frame, I got my range on the 4-hour time frame. Now this is my range from this to this. Yeah. So this whole structure was my range. So I got my bias on the 4-hour time frame. I got my range on the 4-hour time frame. Now I got my entry on the 50 minutes time frame. Okay. Now let's refine down to the 50 minutes time frame. So as you can see on the 50 minutes time frame, this is our range. On the 4-hour time frame, this is our range. So price came all the way down. This low right here on the 4-hour was liquidity. So immediately price came all the way down and new price was going to continue the bullish momentum, right? So I started looking for an entry right here. So this structure right here was my mini range in the 50 minutes time frame. This wasn't my main range. This was the mini range. So I used this range to look for a structure on the 50 minutes time frame, and I eventually found a structure. So if we take a closer look, you can actually see there is a Steven Breaker. Now there are two ways I can use to get into the market. I can use the Steven Breaker concept or I can use the mitigation concept. But most of the time, at least 80% of the time, I use the Steven Breaker. I rarely use the mitigation concept. I only use the mitigation concept unless I have to. So as you can see, this right here is a Steven Breaker. So there was this eye and there was this eye. Now this is a breaking structure. But unlike ICTs, price actually broke two eyes. So this order block automatically became a strong order block. It became a valid order block. So this is the 15 minutes time frame. Now this is how I got my entry. Now let's try to set our position. Now this is our entry price and this is our stop loss. Okay. Now in order to get our TP, we have to use our range. Now this is our range. This is the high of our range. This is the low of our range. Now I know price will keep going in the bullish momentum, right? So I'm definitely going to use the high of the range. Now that is how I got a 1 to 10 risk to reward ratio. So it's very simple. It's that simple. So as you can see, trading is not that hard. It's kind of simple when you look at it. You just need to study, you just need to backtest, you just need to understand the market, and you just need to know how to manage your psychology. You just need to implement money management. You don't just have a strategy and just go into the market, boom, finding a trade setup. No, you have to, be patient. You have to wait for setups to occur. So you don't just get to trade just like that. Now, let's say you want to enter into this trade, right? How do you enter into this trade? So first off, you go onto my FX book in order to calculate your lot size, right? So you're going to click on currency pair right here. So you're currently trying to trade gold. So I'm going to look for gold. This is gold right here. Okay. Then this is your account currency. Just leave it in USD. Then your trade size, just leave it on 1. Then put in your entry price and put in your stop loss. Then you leave it on buy, right? You're on the buy. So you leave it on buy. Then you click on calculate. So let's say, for instance, you want to risk about $50 or you want to risk about $100. So you try to calculate the lot size that's equivalent to $50 or $100. It's very simple. Then when you get your lot size, you go onto your MT5 account and place your trade. Now, I feel like I should show you more examples. I have so many examples I could keep showing you. I have so many trade setup I could keep on showing you. But for the sake of the video, I do not want the video to be too long. So that's why I'm going to be giving you only 2 examples. So as you can see, trading is not that hard. A lot of people say trading is hard. Don't get into trading. Trading is too risky. Yeah, trading is too risky, but it's not that hard. If you know how to master the charts, if you understand how to manage your leverage, how to use the right lot size, how to find the right setup, using the bias, using the range, using the entry, you're going to be unstoppable. So it's that simple. Okay, so this is going to be the end of the video. If you find this video really helpful, please be sure to give this video a like. And if you'd like to get more content like this, do make sure to subscribe and turn on notifications so you can always be notified anytime I upload another video. Thanks for watching this video, and see you in the next one.